In this video, we're going to talk about the three main tax traps that I see people get into when they invest outside the US in rental real estate. So I deal with a lot of Americans that invest outside the US, setting up or buying into rental properties outside the US, setting up foreign companies to invest in real estate. And most people fall into these same traps, or at least don't know about it going into it. So a big part of my business is helping Americans invest in foreign real estate, foreign rental properties, and structuring that correctly so that they're getting the best tax answer that they can out of it and not making it too complicated. And these are the three biggest things that I see that cause the most headaches for people that don't take care of it on the front end or understand these rules going into it. So the first one is the entity classification. So a lot of times it makes sense to invest in foreign real estate through a local legal entity. So one thing people don't understand that's a misconception is if you operate through a local LLC, that doesn't work the same way as a US LLC. So a US LLC defaults to what's called a flow-through. So if it has multiple owners, it's a partnership. One owner, it's called a disregarded entity. But all that really means is that the income and expenses are flowing through to your personal tax return. It's not a separate taxpayer. When you invest in a foreign LLC or a foreign company, and that foreign company offers liability protection in the local country, it defaults to a foreign corporation for US tax purposes. That's a totally different result because now you have a separate taxpayer from a US perspective. The income and expenses are not flowing through. If you sell the property, it's income to the foreign company, not to you personally. You're losing out on capital gains. It's just a totally different animal and usually more complicated. So a lot of times I advise my clients to make what's called a check the box election or an entity classification election to treat that company as a flow through. And then you're getting the same situation as if you had a US LLC investing in a rental property. It's just a lot simpler, but you have to make sure you're invested in the right type of foreign company first and that you make the election on time. That's step one, at least knowing what you're getting into with that foreign company situation. Another thing that I see a lot of people get into is if you're going to use that foreign vacation property or foreign rental property for vacationing. So the second trap that I see a lot of people fall into is when they're actually using that property for some personal vacation. So maybe you purchased a rental property in Costa Rica, you're putting it on Airbnb, you have it through a local SRL or LLC, and you did all the entity classification part right, but you're spending a few weeks, a year down there in that property. You have to understand how that affects how it's taxed in the US depending on your personal use day. For example, if you rent it out for less than 14 days a year, or actually I think it's less than 15 days a year, it's not taxable as a rental at all. So if you rent it out for a week every year and the rest of the time it's just a personal property, you don't even have to report that rental income to the IRS. It's considered a personal property and you don't have to report that. But if you rent it out for more than 14 days a year, it's now a rental property. The second layer to that rule is if you spend too much personal time there, it can affect your ability to take deductions against your income from that property. So for example, the technical rule is if you spend more than 14 days, but your personal days are more than 10% of your total rental days. So to use numbers, if you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. If you rent it out for 100 days a year and you spend more than 10 days there personally, you're gonna have more days than 10% of your rental days. And now that triggers what's called the personal residence rules for these rental properties. And so you're limited to, you can still take deductions up to your rental income, but any expenses above that get put in a different basket and you cannot take those expenses above them. It's worth noting, like if you're near that number, knowing the impact of that, because you potentially lose out on those deductions. They technically get carried forward and you can use them against that income later once you've crossed that barrier down the road. Knowing that rule is important because there is an impact on how much personal days you have on that rental property. So the last trap, or the third trap that I commonly see and have to explain to people, is what's called the passive activity loss rule. So even if you do everything right and you made the entity classification election, you're not spending too much personal time in the property, most cases your foreign rental property is not going to generate net taxable income. And the reason is that you get a deduction for depreciation. So when it's a foreign property, you can depreciate the building for 30 years. So you're getting a direct deduction every year for that depreciation expense. And on top of the other expenses, you're going to have travel, supplies, keeping things up with the property. You're likely going to be in a net tax loss. So a lot of people just assume, hey, that's a great deal. I'll just use that loss to offset my wage income or regular salary income. Unfortunately, you can't do that. That additional loss gets put in a passive activity basket, and it can be used later against other passive income. So if you have multiple rentals, you can use the loss from one against the income from another. Say you have another rental that maybe they've used up their depreciation and you're getting net income, or it just does really well. Or when you sell that property or another property, you can use that passive activity loss against it. But you can't just automatically use it against your wage income. And there is one little nuance to that rule where if you're under a certain amount of income during the year, even if it's a passive activity loss from a rental property, you can deduct up to $25,000 of that loss against your ordinary income. And then it can get a little more complicated from there with applying real estate professional rules and things like that. But the point is, you can't just assume that you're getting that deduction. So take that into account as well when you're making that investment decision. So really, those are the three things I see the most. Classifying your entity correctly if you're setting up an entity in the local country, being careful with the personal days you spend there and knowing how that impacts your tax result in the US, and also looking at the passive activity loss rules, seeing if there's a way you can get around them, or otherwise factoring that into your overall tax situation. If you have questions, leave a comment below or reach out to me personally at mcgowantax.com and book a consultation. If you're enjoying this video, please take a minute to like and subscribe to our channel and leave a comment below.